Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Public Storage Annual Report. Public Storage is a leading provider of self-storage facilities and services across the United States and Europe. The company's primary business involves acquiring, developing, owning, and operating self-storage facilities, catering to individuals and businesses seeking secure storage solutions. The company's extensive portfolio comprises 3491 self-storage facilities located in 40 states within the United States, offering approximately 254 million net rentable square feet of space. Additionally, Public Storage has a significant presence in Western Europe through its 35% common equity interest in Shurgard Self-Storage Limited, which operates 323 facilities across 7 countries under the Shurgard brand. This extensive network provides customers with convenient access to storage solutions, including climate-controlled units, outdoor parking spaces, and other amenities. By offering a range of services and facilities, Public Storage has established itself as a trusted provider in the self-storage industry, serving both residential and commercial clients. Public Storage's stock price remained steady the past year has seen Public Storage's stock price experience minimal fluctuations. Despite being a leading real estate investment trust, REIT, in the self-storage industry, the company's stock has not shown significant growth or decline. Several factors may be contributing to this stability. One reason for the steady stock price is the company's consistent dividend payments. Public Storage has maintained its reputation as a reliable source of income for investors through its quarterly dividend payouts. This predictability can contribute to investor confidence, leading to a stable stock price. Another factor is the company's diversified portfolio of self-storage facilities across the United States. With over 25 locations in 38 states and Washington, D.C., Public Storage has established itself as a dominant player in the industry. The company's extensive network provides a buffer against regional market fluctuations, helping to maintain a stable stock price. Additionally, the self-storage industry as a whole has experienced steady demand, driven by increasing urbanization and changing consumer behavior. As more people move to cities and require secure storage solutions for their belongings, companies like Public Storage are well-positioned to capitalize on this trend. However, it's worth noting that the company's stock price may also be influenced by broader market trends and economic conditions. The past year has seen significant volatility in the stock market, which could have contributed to Public Storage's steady but unremarkable performance. In conclusion, while Public Storage's stock price has not shown significant changes in the past year, several factors suggest that this stability is a result of the company's consistent dividend payments, diversified portfolio, and the steady demand for self-storage services. Public Storage market capitalization of $52 billion is significantly larger than the average industry peer of roughly $8 billion. This shows that Public Storage holds a significant advantage in their industry. Public Storage trades at a higher price-to-earnings ratio of 33 times and a higher price-to-book ratio of 10.52 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 54% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 4.03%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a review of the financial report's extracted summaries. On the growth side, several key factors contribute to an increase in revenue. The expansion of self-storage facilities and entry into new markets are significant contributors, as is the growth in net rentable square feet. Additionally, the acquisition and development of new facilities, tenant reinsurance premium revenue increases, and third-party property management program growth all play a role. On the decline side, softer customer demand, lower move-in rental rates, and decreased average occupancy are major factors contributing to a decrease in revenue. Furthermore, high costs of capital or limited availability of capital, unattractive investment alternatives, zoning and permitting limitations, and local demand and economic conditions affecting development activity also hinder growth. It is worth noting that some sections of the report do not mention specific drivers for revenue growth or decline, indicating a neutral impact on revenue. Net income and profit margins. A decline in performance. The net income of the company experienced a decline from 2023 to 2025. Specifically, it decreased by $76.1 million from 2023 to 2024 and by $287.1 million from 2024 to 2025. This represents a decrease of minus 15.3% in 2025 compared to 2024. The net income from newly developed and expanded facilities did increase by $124.6 million, but this was not enough to offset the overall decline. Profit margins also suffered a decline during this period. From 2024 to 2025, profit margins decreased from 44.3% to 37.3% of total revenues. This represents a significant drop in profitability. The decrease in equity earnings due to lower share of net income from Shurgard and potential loss of partnership status for U.S. federal income tax purposes are some of the reasons contributing to this decline. The company's performance was also affected by compliance costs with extensive laws and regulations at various levels, as well as governmental regulation of tenant reinsurance business. These factors potentially reduced profitability or limited growth. Overall, the net income and profit margins experienced a significant decline from 2023 to 2025 due to various reasons, including decreased equity earnings and increased regulatory costs. The financial documents provided reveal a promising trend for the company's operating cash flow. According to the data, the company has generated $400 million in operating retained cash flow in 2024, which is expected to increase to $566 million in 2025 and reach $605 million by 2026. This upward trajectory indicates that the company is successfully generating positive operating cash flow. Furthermore, the statement on page 107 emphasizes that this cash flow will be sufficient to meet material cash requirements through a combination of operating cash flow and strategic financing options. Overall, these figures suggest that the company is in a stable financial position, with a strong ability to generate cash from its operations. The company's debt level has experienced a notable increase over the past year. According to the financial summaries, notes payable rose by 10.6% from $9.35 billion to $10.25 billion. This significant jump in debt is accompanied by an increase in interest expense, which grew by 5.9% from $287 million to $304 million. The principal outstanding on debt as of December 31, 2025, also shows a substantial rise, reaching $10.3 billion compared to the previous period. Furthermore, the interest expense has increased by $13.1 million in 2025 compared to 2024. However, it's worth noting that the interest earned on cash balances decreased by $13.1 million during the same period. Overall, these changes indicate a significant shift in the company's financial landscape, with debt levels and interest expenses experiencing notable increases. Management is optimistic about the company's outlook, expecting modest revenue growth in 2026. To achieve this, they plan to implement a balanced occupancy and rate strategy, increasing rental rates for long-term tenants every 6-12 months. The company also anticipates growth in tenant reinsurance operations due to increased coverage and higher premiums. In addition to these initiatives, management is committed to expanding the business through development and redevelopment activities, which are expected to generate favorable risk-adjusted returns. The company has a strong capital structure, providing flexibility to adapt to changing conditions and opportunities. Furthermore, they plan to continue seeking acquisitions of additional self-storage facilities to maintain and increase their robust pipeline. Overall, management's strategy is focused on steady revenue growth, expansion through development and acquisitions, and maintaining a strong capital structure. This approach will enable the company to maximize revenues over time while adapting to changing market conditions. The company has a history of paying dividends and buying back shares to reward its shareholders and maintain control over the company's capital structure. In terms of dividend payments, the company has confirmed that it does pay dividends. The total amount paid out in dividends is $4,350,000, indicating a commitment to returning value to shareholders. Furthermore, the company has projected a significant increase in dividend payments for 2025, with an estimated payout of $2.109 billion. In addition to paying dividends, the company has also authorized share buybacks as part of its capital management strategy. Specifically, it is permitted to repurchase up to 35 million common shares. To date, the company has exercised this authority by buying back approximately 24.5 million shares at a total cost of $879.1 million. This demonstrates a proactive approach to managing the company's share count and maintaining control over its capital structure. There are no concerns mentioned in the financial report regarding inventory buildup. However, a potential issue has been identified in the supply chain due to international trade disputes and tariffs. This could lead to disruptions in the company's operations. Despite this, there is also an indication that no information about inventory levels or production capacity was reported, suggesting that these aspects may not be a significant concern for the company at present. But that concludes the financial summary for Public Storage. Feel free to comment below, and I will be happy to answer them when possible.